Hi, it's Pete Birchler here. It is Christmas Eve. It's about 25 minutes till market close currently. The market will be closed tomorrow. We'll probably see some relatively light volume trade for the rest of the week here, possibly even into the following week. So I wish everybody out there Merry Christmas and a great 2013. I hope you have safe holidays. This video is going to cover some multiple time frame analysis of stocks and what I'm seeing here, and this video is going to go along with a detailed post projecting some patterns completing here and what I think is going to happen early this coming year. I'm going to start with the monthly chart of the S&P 500, and this shows a stochastic indicator. I've showed this several times over the past couple months. The monthly stochastics is still in a bearish divergence between the April 2012 high and the September 2012 high. So the stochastics hit a lower peak, and the stochastics is currently in a sell signal. However, to trigger that sell signal, we really need to see price break below the November low. And that'll create what's called a trailing one bar low sell signal, which is a better way to use stochastics for entering short positions. It will dramatically reduce the amount of whipsaws on stochastics rather than just using a cross of the %K below the %D. So this suggests that the market is primed for a potential decline. However, we would need to really see some further price action in order to confirm that as a sell signal. Now, moving to a weekly chart, this shows the S&P 500 on a weekly chart, and it shows both a 21-period stochastics and a 7-period stochastics. And the main point I wanted to make on this is the cycle setup is almost identical to the cycle setup in 2011 in July, and in early January or in December of 2007, early January 2008. And the setup that occurred at those time frames was a divergence in the indicators between, in this case, in 2011, the May price peak, we saw a divergence relative to the prior price peak in March. And then the 21-week stochastics declined and rallied back up above 50 to a lower high here and started to converge. And what we saw on the 7-week is a rally back almost up to the overbought level when that happened. If you look back to the high of the 2007 bull market, we saw a similar divergence between the highs in July of 2007 and then October of 2007. So stochastics made a lower peak here relative to here. And then the 21-week stochastics declined and made a relatively weak upward cross lasting a few weeks, and that occurred with the 7-week hitting oversold, coming back above 50 and starting to converge and triggering a sell signal basically the first week of January or so. Currently, it's almost the identical setup here. We saw the 21-period stochastics come down below 50. The 7-week got oversold. It's rallied back up to overbought. Price is still at a lower high. We see this 21-week starting to converge here. So if we see this weekly stochastics down here enter a sell signal coming at a lower high prior to the last overbought signal, that could be setting the stage for a multiple time frame momentum tailwind, basically pushing the market down, probably challenging the October and November 2011 lows. So that's the main setup here that I think is going to drive the market over the next several weeks. Is if we do see the current shift on this weekly stochastics, I think we'll get some follow through to the downside, and a break of the November low will probably be a significant continuation point on the market, rather than an area of support. So I would not look for the market to necessarily reverse off of support there. And in fact, if we do see the market put in a reversal type bar there, I wouldn't necessarily trust that. I would definitely use a stop very, very tight below any reversal that happens there if you take any type of long signal after a break of the November low. But I would really suggest waiting for that level to be broken, and if it is, and you're considering trading long, wait for the market to rally and then form a higher swing low on whatever low breaks that November low before considering any type of long trade. Until proven otherwise, I would assume this market has significant downside underneath it. This is a chart of the Dow, and there's a similar multiple time frame momentum setup in the MACD here. I'll click over to a weekly chart. We can see that there was a divergence in the MACD between the September highs and the May highs from 2012, and the MACD is currently in a sell signal, so the MACD line is below the signal line, and so the trend coming off a divergence should suggest to us that there's possibly an extensive downward move coming, and since the MACD is still in a sell configuration, we should still really be looking for short trades or inverse trades to the market on a shorter term time frame. So if we then look at a daily time frame chart, we can see the MACD has been in a buy signal since mid to late November, and it's starting to turn down here. So if we get across of the MACD to the downside here, while that weekly time frame is still in a sell signal, that's an excellent multiple time frame momentum signal that would suggest to us that there could be significant downside coming on this move. Another possible scenario here, and one that I think may be more likely to occur, is for the this initial potential sell signal here to whipsaw, and for the market to then bounce back up and possibly move to a slight new high above this mid-December high, and then if that is then followed by a bearish MACD cross, with or without divergence on the MACD, I think that would be probably the ideal signal to look for here in MACD as far as if you're going to use that setup for your short entry. Moving over to the hourly chart, this is of SPY. We can see that the after the big gap down here late last week, the hourly MACD is oversold, relatively oversold. There is no divergence in it yet in oversold territory, so we may see the market continue sideways to a little bit lower. Ideally, to set this up, we would see this move back above the zero line, and ideally also move to a slight new high above this December high, and give us really a stronger divergence type of a signal. So I think that's what to look for here, but certainly with this large gap down and the current setup, it would be reasonable to enter short positions now or on the MACD cross signal on the daily chart with a stop above this December high. But if price does come back above that high, would be willing to, if stopped out, re-enter that trade if the price turns down and we get another bearish type of technical signal there. Now I'm going to move over to a chart of some COT data and show you what the smart money is doing here. This is a COT index I've constructed and basically looks at what the smart money is doing relative to what they've done over the past few years, and we saw a significant sell type of signal. So when the COT index is very, very low, that indicates the smart money is selling. And so even though that's low on the chart here, we're really looking at selling. So the smart money was selling heavily at that point, and that would indicate that typically the price will go down in the future. We did see that. Price did move down into November. We saw the COT index rise above the 50 level, and it actually gave us a very nice buy signal on a COT movement index. So when these green bars get above this horizontal line here, that's a pretty classic signal for an established uptrend. That means the smart money has been buying over the last several weeks. They've been moving from short to long relatively rapidly, or at least decreasing their short position relatively rapidly, and that'll typically coincide with corrective bottoms. That did in fact happen, so now we've seen a rally off of that November low, but the smart money is now moving quickly short again, and it's back near major sell territory on the COT index. It's somewhat similar scenario again to what happened between May and July of 2011. On July, on the right shoulder of a daily head and shoulders topping pattern there, the COT index did not really get back to the same level, low level that it did in May. And in that case, the NASDAQ actually moved to a higher high above the May highs, while the Dow and S&P did not. In this case, we've seen the New York Stock Exchange move to higher highs as of this past week, but the Dow, S&P, and NASDAQ are off of the highs still. So there's a very similar momentum setup, there's a similar COT setup, and actually a similar pattern setup to what occurred at that July 2011 topping time frame. What I'm going to do is move down and show the net position chart here. So this is looking at the commercial net position. So this is a zero line, and if the commercials are heavily net short, that means they are hedging, and typically that will correspond with future weakness in stock prices. When they are heavily net long, that will typically correspond with future gains in the stock prices. What we see right now is kind of a non-confirmation or divergence in the COT commercial net position, very similar to what we just saw on the COT index, in that they are back near their net short total from September, but not quite. But given the New York Stock Exchange is at a higher high, that creates this divergence in the COT and the price. And that is also very common at major turning points, is seeing a type of divergence in the underlying net positions. Let me move down here and show there's a similar chart of the spread between the commercials and the smart money and dumb money, so to speak. So the spread between commercials and the large speculators hit a very low level in September, and again that's at a slightly higher bottom right now. So if we do see the market price turn down and this spread start to move back up, that could be indication of a significant time frame type of topping pattern in stocks, given the non-confirmation or divergence in the underlying COT data. So basically what we have in summary here is a likelihood of the monthly term monthly time frame momentum turning down in stocks. We have smart money selling relatively heavily with a divergence suggesting downside prices to come, and we have some shorter term daily time frame setups possibly ready to trigger over the next couple weeks here. And so I think that what we're going to see in early 2013 is probably some very considerable weakness in stock prices, and that's the kind of hypothesis I'm operating under here. So check out the post that this video is in for further details on the pattern that's playing out in the market here and how to track that as far as whether that is unfolding. There could be a very significant profit potential in buying some February to March put options on the stock indexes or specific sector ETFs over the next week or two here. Ideally, that would happen on a push to new price highs for this rally since November. If we get that followed by then a daily time frame sell signal or even an hourly time frame sell signal on the MACD, that could just provide a very outstanding type of profit potential on out-of-the-money put options for the stock indexes. So that's something I may update over the next couple weeks here as that pattern unfolds. But that's really all I wanted to cover for this update. We'll see how things develop here over the next few months, but right now I really suggest having any type of, if you have any type of long positions, to have stops protecting those. When a major pattern completes like this, we typically will see some tremendously vertical type of price action, and oftentimes there can be sizable gap downs in that price movement as well. So you want to have stops in place if you are long or if you're in growth stocks. If the market does what I think is likely to happen here based off of this setup, I think there's probably going to be very, very few stocks that are spared of some significant decline. So you want to have stops in at reasonable levels to take you out if the market does really turn down here. So have a great Christmas holiday. I will probably update with a video again roughly around New Year's or slightly thereafter.